Hello, everyone. John Hutchinson with Traders Reserve's Filthy Rich Dirt Poor. Uh, Obviously, we're going to have a pretty difficult day in the markets today. I do want to go back through the presentation we were trying to share with everybody via the live stream on Monday. So you're at least up to date, and I'll add in a few extra points today. I'll try to keep this relatively short because a number of things are already known now. For example, the inflation report came out first thing this morning. Inflation was higher than expected. And so that removes the narrative that inflation had peaked between March, April, and May. And the main thing that I think that does is it removes the narrative that the Fed might pause its rate increase schedule after September. Not going to happen. Um, it also, I think, puts back on the table a three-quarter point rate increase, probably for July, not for June. I think the Fed will stick to the half point increase in June and see what inflation data for June is at the beginning of July. But I do think that if inflation data remains elevated uh, going into the July meeting, that we could be looking at either a three-quarter or full point rate increase by the Fed in July. So we'll have to keep an eye on that. Listen to the press events that the either from Jerome Powell or from the different Fed governors. But that's going to drive markets lower. Market have been betting on both that the Fed would pause and that the Fed would maintain lower rate increases. Uh, that's not going to happen. I don't see that happening right now. Another major driver of the markets lower, at least yesterday, was China reimposed partial lockdowns in Beijing and Shanghai. Uh, that is, in a sense, an abandonment of the belief that China would abandon the zero COVID lockdown policy. The real problem here is China's continued lockdowns do two things. Number one, it slows the recovery in the global economy, and number two, it slows the recovery in supply chain issues. Even if or when China is back at full manufacturing capacity, you're still looking at a 3 to 6 month timeline before that that activity has economic throughput. So the longer these types of lockdowns go on, the farther out these recoveries become. A trend that I'm watching now, and I'll have Jeff map this out for you next week. After next week's jobless claims number is a rising trend in weekly jobless claims. This is on a chart basis. What you would see is what would be called a bullish or uptrending channel. It's not bullish with obviously rising jobless claims, but the chart analogy or the comp would be a bullish channel. And that is formed by higher highs and higher lows in the channel. And that is what we are seeing in the weekly jobless claims. We need that channel to break to the downside to give more stability or lend more stability to the job market. But if that channel continues to rise in the pattern that it has been rising, then as we start looking forward to early July, early August, even early September, those jobs reports start to take on more importance because of their potential impact to the worry about recession. And we've said for several weeks here, we think that we are already in or meeting the technical definition of a recession. If Q2 GDP comes out positive, I'll be shocked. I would not be surprised at all to see it come in with a slight or small negative like it did in Q1. And if it does, that would meet that technical definition of two or more consecutive quarters of negative GDP, negative growth. Uh, I think we're already there. Consumer spending may be consistent, it may be higher, but how much of that consumer spending right now is being driven by having to spend more money for food, clothing, shelter, gas, etc. So there's an argument to be made that the inflationary impact is propping up GDP to a degree, where if GDP really starts to fall dramatically in quarters ahead, that's where I think we start to see some real difficulties. So the last point I wanted to make: yesterday, the ECB surprised markets with a rate increase planned for September, half point increase. We will talk next week about the impact of that. It has broad impact both in Europe and in the U.S. and globally. So it's not just a small thing. It is a hawkish surprise, and we need to share it with you in a bit more detail, which we will plan to do next week. The 10-2 yield curve on Monday, what we would have told you was that this range that the 10-2 yield spread has been, yield curve has been stuck in for 2 months, was critical, and that it was driving the S&P one way or the other, up or down, and that a break above 40 basis points would have been, I think, a positive for the markets. It would have implied that the bond market did not believe in the hawkishness of the Fed, and that the underlying economy would not fall dramatically into a deep recession. A break below 20 basis points, however, the bottom end of this range, would have been a very negative sign. It would lead us toward a second inversion in the yield curve, and raise the probability of deeper recessionary impact, which I'll talk about in a second. As of this morning, the yield curve has broken below that 20 basis points, hasn't closed there. So this video is being done at 10:30 on Friday morning. But as of this morning, the 2-year yield was up some 8 basis points, and the 10-year yield was flat. So the negative effect in that was we were down to around 13, 14 basis points. So it was a pretty big drop. And if we get down to 10 again, 10 basis points, the yield curve will invert a second time. And I do think that has impact on the S&P 500. I'm going to skip this for this chart, which I originally had, and go to this one, because this is now the important chart. This is the S&P 500. We had been stuck, or have remained stuck, in this trading range between 39 and 4,200, fairly wide range. Not only do I think we test the low, I think we start to bring in the next legs down, given the inflation data, given the increase in interest rates. I think this starts to push the market lower again. The next level of support is around 3,700. The level of support after that is around 3,550. I don't know that we're going to get to 3,550 right away, but I do think that we now have greater emphasis on the July earnings period. And if we have earnings in the second quarter similar to what we had in the first quarter, where there was we had a higher number of companies missing or guiding lower into future quarters, that's where I think we start to test and seriously look at where the bottom is in the market. I think right now what the market has the most difficulty with is how to value all of these, this confluence of data, of issues and data. Everything from higher inflation to higher interest rates to high employment or low unemployment, rising wages, rising costs for businesses. This is a confluence of events we really haven't seen, I don't think, ever, at least not on the employment side, where the economy is effectively running at full employment. So where I'm most concerned, and again, this is another area where we will do a deep dive for you folks in the upcoming weeks, is on small businesses. And my biggest concern is a small business recession, which leads to a deeper economic recession. Small business is and always will be the growth driver for the U.S. economy. So my suggestion is shop small business this weekend, please. But the reality is that small businesses can only take so much pressure before they can't. Meaning so much rise or increase in the cost of hiring people, the limits to adding people so that they can either maintain or grow their businesses due to fewer workers being available, the rising cost of operating their business, the rising cost of debt, and then couple that with the fact that if they have to raise prices, how does that impact their overall sales revenue? So I'm very concerned about a small business recession, which then leads to a wider recession. On the other end of the spectrum, Apple, for example, Apple's going to be fine. I'm not worried about Apple. You're not worried about Apple. Nobody's worried about Apple. Apple's not worried about Apple. I'm deeply concerned about small business in America right now. They are the ones who need help. They're not getting it. They have no way to get relief. And without any relief, without any outlets, that's where we have the greatest risk in this economy. And that risk does flow up into the stock market, even though we're not talking about publicly traded companies. It affects consumers, consumer demand, consumer spending, everything from staples to discretionary. So this is where I think the recession begins. So that's what we will be looking at. I want to stress that the data at the moment does not yet support the lows in the market, even though we will retest them. I think we needed to retest them, but we needed to retest them when the data supported it. For example, manufacturing and service sector data was still in expansion territory for May. Now, I don't have June numbers yet because the month isn't over, but that's another thing that we have to watch. So we're starting to get a longer list of things we need to be watching, which can inform us in advance that the economy has, in fact, tipped into a recession beyond what affected the numbers in the first quarter, which was rising imports. That'll probably have an effect in the second quarter as well. But it wasn't that. Remember, it was not that consumers had stopped spending money. That's the point where the recession becomes a greater threat to the stock market and to your trading. So that's what we'll be watching for. Finally today, valuation. And this, I think, is where the market is really struggling right now. As I said, with a confluence of data and events and circumstances and issues, this is where the market is struggling. I have three different multiples here. These are forward multiples based on 2023 earnings, which are now expected in a range of $240 to $249 full year EPS for the full S&P 500. Current year EPS is estimated at $225, which again, that's why Q2 is going to be so important. If companies did not rebound on EPS in Q2, that will put more pressure on Qs 3 and 4 to make up for a shortfall or a decrease in this year's earnings. If this year's earnings fall, next year's earnings will fall as well. So when you look at these multiples, the market right now for 2022 earnings is trading at roughly 17.5 times this year's earnings. And if we look at next year's earnings, you can see that we're already trading in that 16.5 to 17.5 range. That's where the market has been trading. It has been trading in a fair value range for the last couple of months. So if these EPS expectations change to the downside, that will drive the S&P value lower. We need a positive catalyst. Any positive catalyst that can drive the market multiple higher. We don't have that right now. It will come. It will take some patience. It will take some effort in your trading. I can't stress enough. Be patient. We will get you through the rest of the year as profitably as we can, but more importantly, as stable and consistent as we can. I wouldn't rush for the exits, but I would start stockpiling cash, not for a rainy day, but for when the market does put in a bottom and begins to march higher again. I still see that bottom right now as the 35.50 level. I would like to see that level tested and the market come back off of that, not because I want to see the market go down another 10%, but because I think that gives us a more reasonable valuation in the S&P 500, and it cleans out a lot of the dead weight that was caused by the rapid rise and the unsustainable rise in the S&P 500 in mid to late 2021. So we've been dealt a couple of cards off the bottom of the deck. We've got to play them and then get new cards. And those new cards are coming. I am still bullish on this economy for 2023. And there are certain sectors which we will begin highlighting for you as we go through the summer and fall in our daily Filthy Rich Dirt Poor newsletter. So keep reading. Thank you very much for being a reader and obviously a follower of our little video today. We will retest the live stream in 2 weeks, and we'll make sure we get all of the technical details fixed for you before we do that. So hang in there, be patient. Don't be afraid to take profits off the table. If you're a long-term investor, look at the individual stocks that you hold and ask yourself a simple question. Would you still hold this stock 2 or 5 years from now? And if the answer is yes, then hang in there, because these stocks will recover. Apple's not going to zero. GM's not going to zero again. We don't have another 2008, 2009 on hand. This is not what's happening in the market right now. This is, as I said a couple of times, a confluence of events that has not happened in the way that it's happening ever. So we're in uncharted territory. Patience and a little bit of time, and we will get you through it. Outside of that, I hope everybody has a great weekend. Remember, like I said earlier, shop small business, please. But keep your eye on upcoming issues of Filthy Rich Dirt Poor. We have a lot of data to share with you, more trade ideas each week. Remember, you can always email back to us from our daily email to you any questions that you have, any topics you want us to cover, or any stocks you want us to review. We're happy to add those into our daily or weekly issues, or even the live streams, which we will be doing ongoing into the future. So thank you again for being part of Traders Reserve and our family. One last update. At the end of this month, we'll also give you a 6-month analysis on some of our core services, which are all beating the market right now, like Triple Play Income, Small Account Trader Pro, and the 5K Income Challenge. If you didn't see the announcement, make sure you find it. We're doing a special presentation on the 5K Income Challenge on Thursday, June 23rd at 7 p.m. I'm going to do it at night because I'm hoping that more of you will be able to take part in that. Some pretty exciting developments in that, and they can help you in your trading. So outside of that, for Jeff Wood, my daily editor at Filthy Rich Dirt Poor, and everybody here at Traders Reserve, thank you for being part of our family. Hang in there. We'll get you through this, and we'll see you again next Monday with our next issue of Filthy Rich Dirt Poor.